It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Welcome you back, the podcast, the award-seeking podcast. We're working toward. Did they give out Nobel prizes for podcasts? Because I was going to put our. We're
going to get nominated.
I don't think there is anything like that. I was just thinking. I make it a habit. I'm Johnny Dean, by the way. I'm your podcast host. I'm not an advisor, but I'm here with an advisor who is Professor Rick Plum.
That's me.
CFP professional, certified financial planner, and all-around good guy, knowledgeable guy. And I make it a habit to look around other podcasts. Not that you folks listening should do that. Financial podcasts is what I mean. And I tell you, it's just not. It seems to be a lot of fluff out there, or generic type advice, or stuff that you could probably just read online. As I'm talking about, we talked last week about something that I think you get articles and things on that. Our last podcast had to do with things that you need to be ready for, getting your house in order, your stuff in order for your tax preparer, and what you need to tell your tax preparer. I did not find anything in the last several days online that gave me any substantive information beyond just the rudimentary facts. We got into stuff last week that I think was very, very helpful, and I honestly could not find it anywhere, that kind of information anywhere else.
Well, partly, I think, because the people that you're reading are writers.
Well, that's true. They're not actual
They don't actually
advisors.
work with people.
That's probably true. But I mean, that's fine. But my suggestion would be keep listening to this podcast, because we're going to be giving you information once again that I honestly don't know that you're going to find anywhere else. Or if you are, it's going to be very difficult to do so. Now, last week, as I said, we talked about taxes. If you're one of our regular listeners, you know that. And this week, I want to follow that up with a little bit further discussion on taxes, something that came up at the end of the show that I brought up, or somebody. And it has to do with understanding tax brackets. Since people are thinking about taxes this time of year, at least they should be, they probably are, to one degree or another, I wanted to get into this discussion of tax brackets. And this was always a popular topic when we did this, I don't know, once or twice a year on our TV show.
Well, that was a while back.
It was, but this always got people's attention, because there is a lack of understanding, and rightfully so, about how tax brackets work. And now some people might say, well, gee, tax brackets, really? But honestly, from what I hear from people who say, I made $95,000 last year, and 20-something% of it, went to the feds for taxes, so I lost
20%, $20,000
or whatever. Yeah, I made $100,000, and then I had another $8. So I lost basically 30 cents for every dollar. My state and my federal, and honestly, that's not the case. And I'm not here to debunk anything necessarily, but I think it's prudent to provide some tax knowledge here for people.
And one of the first things when people talk in that vein, what they are doing is they are combining multiple taxes together. And you're probably paying that much in taxes, but it's not your income tax necessarily. That's the biggest piece of the tax. It's your FICA tax, and you don't even really see it because it comes out of your check before you get home.
Yes.
But FICA tax for a lot of people is as big or bigger, especially self-employed people, that is the biggest tax you pay, not the income tax. Now, income tax is a big number too. We don't like it, but there's a lot of confusion about what tax bracket you're in. Why do tax brackets matter? How do we go about, managing our tax situation? And unfortunately, you have to understand the terminology, and you have to know which issue you're trying to manage.
Yeah.
Because they trigger off of two things. And the reality, unfortunately, is the income tax part of it is the easier part. When you get into then looking at the taxation of Social Security benefits, the IRMA and things of that nature, those are different than trying to figure out what tax bracket you're in. But understanding your tax brackets and understanding what that next dollar of income is doing to you can be an important part of managing one of the biggest expenses we have, and one of the least the popular expenses
Enjoyable?
we have, least enjoyable expenses. Taxes. Taxes are an expense to a household. I mean, obviously, if we didn't have to pay taxes, we'd have more money to do other things with.
Sure.
But we have an obligation to pay a certain amount of taxes, and we have a tax code, and there's a terminology that's in a completely different world for most people. You've got gross income, you got adjusted gross income, you got taxable income, you got modified adjusted gross income. And you have to find out the modified adjusted gross income before you can find out the taxable portion of your Social Security, to then find out what the taxable income is, to find out what tax bracket you're in, and your capital gains are at a different bracket than your ordinary income, and they don't match up exactly. There's a little crossover in those numbers.
Tiny bit.
I was like, what the heck is going on here?
Well, and the purpose here is to help people understand to a degree. I think when it comes to things like understanding tax brackets, and it's helpful to have the advice from somebody who understands, like a guy like you, who knows kind of how this stuff works. Because when it comes to things like decisions that many people have to make, Professor Plum, really any time, but especially as they get older and in their 50s and all that stuff and 60s, as they approach things like Social Security age, they start to think about, do I do some Roth conversions here, right? Do I take some money out of my IRAs?
We had the question the other day, should we start our Social Security at 68, but we'll have to pay, we're still working, we'll have to pay taxes.
Yeah.
Or should we wait until 70, because it does go up at 8% a year, 2/3% per month. And then we'll have a bigger number, but we won't have any taxes, but maybe our longevity doesn't fit. So there's a lot of these different things. How is that going to affect our current taxes? Yes, we're going to get money now, but we're not going to be able to keep it all. So how much am I actually getting now compared to what I'm going to be getting later?
Yeah. So let's talk about this. First of all, I think the first thing that people need to know, and this is just me talking, maybe you would disagree, but I think the first thing people need to know is that if you look at the tax chart, you're going to see a 10% bracket, you see a 12% bracket, a 22, I believe.
Yep, 22, 24, 32, 35, 37.
Yeah, so if you just look at that, and it says, well, the first $22,000, first $0 to $22,000 is in the 10%.
For a married filing a joint return in 2023,
yeah,
the 10% bracket starts at your 0 and goes to $22,000 of income.
But see, right away,
taxable income.
And right away, this is where some confusion can start, because Professor Plum, strictly speaking, that's not true.
Because when we look at just the brackets, now I've seen this happen before. Somebody says, well, my wife and I, we make $100,000. So I look at the tax tables for a married filing a joint return, and it says, as we said, 0 to 22,000 is in 10, 22 to 89,450, let's just call it $90,000. 22 to 90 is in the 12% bracket. I make 100, so that means I'm over 89. I'm in the 22% bracket.
Right, like we said, yeah.
So that means I make $100,000. I'm going to pay 22%, $22,000 in taxes. First off, no, that's not how it works. Luckily, thankfully. Yeah. Oh, heaven, thankfully. And the second issue is this chart, and all tax charts that talk about brackets are talking about your taxable income.
Not all income is taxable.
And not all income is taxable. So you may be making I use 100 because it's a nice, easy round number.
Yeah, of course.
So you make 100,000 married couple, but you put some money into your 401k and the deductible side. Maybe you put 10,000 in. Now your income's down to $90,000. But even if you don't do the 401k, for everybody, every taxpayer in the United States right now, there is a deduction. We get the first X amount of dollars that we do not have to pay taxes on.
It's called the standard deduction on the tax form.
And so you can either use the standard deduction, which for a married couple filing a joint return is a little under $28,000. So
for 2023.
2023.
Yeah.
So for 2023, the first $27,700, call it $28,000, a married couple earns, it's not taxable. Now, you can't live on $28,800, but $28,700.
Well, if you have Roths and other, potentially you could. But all right, yeah. So if I made $700 of income that year, I would not be taxed on that at all. If that's all I made,
Right.
It would be a 0% tax bracket. In other words,
Exactly. You would not, because what they do is they take the 22. Let's say you make $30,000.
just made 30 as a married couple.
Yeah, 30,000 shows up as taxable income, or as gross income.
Yes.
After all deductions and everything else, everything happens, and that means the first 27.7 of that is wiped out by the standard deduction.
So really, I'm only taxed in your example on
$2,300.
Yeah.
And so now
I'd
that
pay-
$2,300 is in the 10% tax bracket.
So I pay $230 of
in
taxes
federal income tax.
on what amounted to, in this example, $30,000 of income.
Right.
So even though I am technically in, at that point, a 10% tax bracket,
Yeah.
what percentage have I paid? Less than 1
Yeah, like
in that example?
0.23%.
Yeah.
It's a very small number, but
that's how it works.
so somebody who makes $100,000, they're going to reduce their income by the 27.7. So they're going to go down to 73, 72, 3. They're
Let's round it to 28,000.
28. So we're at $72,000.
$72,000
gross of taxable income, and at 72,000, that means I'm under the threshold for the 24. So I'm in the 12% bracket, because the 12% bracket goes up to just shy of $90,000.
Yeah.
I'm below that, so I'm going to be paying. I'm in the 12% bracket.
But you thought, if you didn't know any better, or if you didn't understand how the tax brackets work, you would have thought that making $100,000 of
looks like the 24%.
looks like I'm in the 24. You're actually in the 12.
Yeah, the 22. Excuse me.
Or 22. I'm sorry. Yes, you're right. You
But
thought you were in the
12.
20, but you looked it up online. You said, "Well, I made $100,000 last year.
Yeah.
I'm in the 22 bracket." You're not. You're in the 12.
Your gross income was 100. Your taxable income was 72.
Big difference.
And you have to understand those issues. What is gross income? What is adjusted gross income? What is taxable income? Taxable income is what they actually apply the tax brackets to. And this is the difference between the two, is one of the bigger areas of the difficulty in the tax code, defining what is income, defining what should be in the taxable income. That's not going to, that is taxable, is not taxable. How's it going to work? And that's where a lot of the debate happens. And to people that talk about a flat tax, the biggest debates become not the rate, but what gets taxed and what standard deduction should be applied to that flat tax. Because a flat tax, if it just goes to everybody, starts taxing lower wage earners pretty heavily.
Sure, of course it does.
Because it's much harder. I mean, a 10% tax on them is much harder to meet than a 15, 20% tax for somebody who makes 200,000.
Of course, it's a question of being
so the
able
idea
to
is
pay
that
your
they're
bill.
going to exempt some amount of money on a flat tax. So maybe, and the numbers I saw in the last go round was the first $50,000 or so would not be taxed at all, and then the flat tax, and they will never pass this.
Never. It
would be up on above that.
It would be horrible.
But there would be a big fight on what is income. That's where the issue is. And is there going to be a different capital gain? Anyway, forget the flat tax. We had about as close to a flat tax as we'll ever see. And well, a lot of people listening maybe not have been alive at the time, but in 87, when we had
after the tax reform, we had
15 and 28.
Yeah.
And the 15 ended about where the FICA tax ended. And so the FICA tax was, 7-8%. So you had like a 23% tax combined coming out for the first X amount of dollars. And then when the FICA tax ended, because FICA is only paid on the wage base, a certain number, then it went up to the 28% bracket. So
we don't have that anymore. We don't have that anymore. We now have
convolution.
6. But I think this is what people like, frankly. I think this is better because this gives you ways to, I don't want to say game the system, but you actually can. I mean, Professor Plum, if I make $100,000 and the standard deduction brings me down from
to
72, I've gone from a 22% bracket down to the 12.
Right.
Now, if I want to make some contributions to my 401k, well, it'll be kind of hard to get down below the 12.
You're not going down to 20,000,
like,
22,000.
No, I can't because I can't contribute that much to my 401k. But I mean, there are ways to look at things.
But knowing where you are on that tax bracket, where you thought you were in the 22, now you're in the 12, you're at 72,000, and you can go all the way to basically almost $90,000. It means you have $18,000 worth of room in the 12% bracket.
Mm-hmm.
Where before you thought you were in the 22 and you were thinking, man, there's no way I want to take any more money out of my IRA or anything
Oh
of
yeah.
that nature.
Oh, this is great. This
now
is a
you're
great
looking
example.
At, well, I'm only in the 12. That's a lot cheaper. Maybe I will do a conversion of some amount of money and bring me up to the top of that true 12% bracket. Now, before we get there, though, the 12% bracket, you're not paying 12% on every dollar, even at that point. We have a progressive tax system. We start with the standard deduction. It wipes out the first X amount of dollars. For a married couple this year, it's going to be just shy of $28,000. For a single person, it's half of that. And so the first X amount of dollars is not taxed at all. And you talked about 5 or 6 tax brackets. There's more like 11 or 12. And so
when you count the
capital gains brackets.
Yeah.
And then you start adding in all the other additional taxes on top of that, you get even more. But like I said, you've got $78,000 of taxable income. After you had $100,000 of gross income, $78,000 of taxable, but the first $22,000 is still in the 10% bracket. So we still only pay 10% on that first $22,000. And then the difference between the 22 and the 72, the next 50 is taxed at the 12. It's when we go into the 12% bracket, it doesn't retroactive down to $1. It only retroactive back to the bottom or the top of the previous bracket.
Yeah, so some you're paying at 10%
Right.
and some you're paying at 12, and whatever the combination is what you.
So if you're lucky enough to have a taxable income of $693,701, that means you are in the 37% federal tax bracket.
Is that the low end?
That means you're $1
I'm $1
into the 37% tax. So
But only
one of those dollars,
$1 is taxed at 37.
a block, the first 22,000 is taxed at 10%. Then there's a block, another 68,000 taxed at 12%.
Right. Okay.
Another $100,000 taxed at the 22% bracket. Another, almost 200,000 taxed at 24.
And so on.
But each one of those brackets doesn't regress and take away the previous bracket.
No. So if I made 630, whatever you said,
693,751.
yeah. So if I made that much, I'm now in the 37% bracket. That doesn't mean that now I would owe a check for 37.
Yeah, it wouldn't owe 37% of that number.
Yeah, no,
it's a combined.
Why is this important? Okay, so this is important to understand, and people might say, "Well, why?" I mean, but Professor, you brought up something very, very good. Okay, let's say I know that I have an income of $100,000 just to make it easy, right? And I go online and I see, well, the first, I make $100,000. The chart has put me in the 22% tax bracket. Well, that's horrible. But I'm not thinking about the fact that if I'm let's say I'm a married couple, that I get to wipe out the first 28,000, call it, of income. So really, taxable income's at 72, which means that no, I'm not in the 22.
I'm in the 12.
I'm in the 12. So you brought up, a planning opportunity here, which says that, well, I've now got about, 25,000 roughly of room. How much room do I have?
18.
18,
25,
whatever. It's
25 or 6 to 4.
20. I have, but now that I understand how the tax brackets work, I can look and say, well, gosh, that leaves me $18,000 of room in the 12% bracket. Well, now I'm starting to think, well, gosh, I wonder if it would be a good idea to take some money, let's say, out of my IRA
and move it to Roth.
Convert it into a Roth. And now, why would I do that? Why would I voluntarily pull more money out?
Because I don't think, depending upon the
pay
person,
extra taxes than I would have ordinarily
I'm
owed.
looking at what it's costing me today. I know it's going to cost me 12% federal. And I'm looking at down the line when I get to 73 and I'm taking my Social Security.
Age 73.
And I'm looking at what is that dollar going to cost me when I take it out then? And I may still be in the potential 12% bracket, but the problem is now you got an interaction of Social Security, and it may be costing me 20 cents federally for every dollar I take out of my IRA at that time. What would you rather pay on your IRA, 12% or effective 20%?
Yeah, I'd rather do it now. And so this is where I think a financial advisor can point these things out to you and say, hey, you know what? This is an opportunity. Yes, you will have to write, you will have to pay a little bit more taxes now, but eventually you're going to owe taxes on that money anyway.
Another area that I see people misunderstand the tax brackets is they say, well, between my Social Security and my IRA distributions, I'm at $90,000. I'd really like to go on vacation or do something else. And I need some more money, but I don't have room. I don't want to jump into the next tax bracket. If I have more than 90,000 of income, according to or what is it, 89,700,
call it 9,
89,450, $90,000.
90,000.
If I take more out, then I'm in the 22% bracket. So I am going to curtail my lifestyle so that I only have that $90,000 of income. I'm just going to arbitrarily say I don't want to pay the tax. I don't want to jump into the next bracket. But the reality is you're not in that bracket because you're looking at gross income again compared to tax. And this is where I see people changing their lifestyle because of a misunderstanding about the tax code. They think that they're right at the top of the 12 when they've got $27,000, $28,000 of room left in the 12. They could take that cruise, that vacation, go see the grandkids, pay down the car, pay off the car, or whatever the case may be, without jumping brackets.
And the funny thing is, these are people who really actually are proactively looking.
They were
in
looking
most cases,
at it.
They are doing this and saying, I'm becoming an informed person, which is, admirable. I think you should do that. But because if you just Google it or you look at a tax chart or something online and you find how much money is being taxed at what level, and you didn't know that there was a standard or forgot that there was a standard deduction that wipes out the first $26,000 currently of married couples' income, or 28, I guess, right?
Close to 28.
Yeah. That you didn't know that. I mean, it's completely messed up not only your tax situation, but your life.
In many cases, when messing up your tax situation can't screw up your life. I'm sorry. Emotionally,
this is why we talk about things like this.
And the problem is, this is not easy. These are not easy concepts to grab.
Yeah.
And we're not even talking about the complex stuff. We're just talking about ordinary income.
Mm-hmm.
All of this is IRA, pensions, wages. We're not talking about what if some of it's qualified dividends or long-term capital gains. What if some of it's Social Security?
Yeah.
Those throw more complications into it, those complications, the more complicated it gets, the more opportunities that may exist to manage it.
Well, isn't that why we said that? I had said that we're never going to go to a flat tax because, number one, it's unfair, but number two, the complicated nature gives us more options for paying less.
And when you're using these rules to your advantage, they're wonderful. When somebody else uses them to their advantage, it's a loophole that needs to be shut down.
Exactly.
But it does get complicated because, like I was saying, all we're doing is talking about ordinary income, pensions, IRA distributions, wages, interest. But in that same example, in years like we had in 2021, I'll have to go back a little time for this one.
You mean when we had an up market?
When we had gains in our stocks.
Quite a few, actually.
Years like that, somebody who was looking at their tax bracket, incorrectly looking at gross income instead of taxable income, thinking they were in that 22% bracket. And while they don't match up exactly, they're fairly close. The 22% ordinary income tax bracket closely matches up to the 15% capital gain bracket. So somebody may be looking at it and saying, you know what, I had a lot of gains this year. I'd like to sell this position, but I don't want to have to pay 15% capital gain tax on that sale.
Yeah.
But the reality was their income from a taxable standpoint was only $72,000. So they still had some room in the 0% capital gain tax bracket. They could have another almost $18,000, not quite, but almost $18,000 of only long-term capital gain,
right,
and have it show up in the 0. So they could reposition that potential security that they wanted to sell. They could do some harvesting at the lower bracket. They could sell it and buy it right back and reset their basis so future growth wouldn't have to worry about, or they could, in a year like 2022, sell it and create a capital loss.
Well, this goes back to something we did a long time ago. I still have to do a webinar on it, but how you can make $100,000 of income and pay no federal taxes.
First, get $100,000. Thank you, Steve Martin.
You can be a millionaire. Not quite a millionaire, but
what was
but this has to do with the understanding how the tax brackets work.
And the long-term capital gain brackets, and the long-term capital gains sit on top of the ordinary income, which it makes it a little bit easier to understand. So when we first go through it, we put everything together, we mix it all up, and we say, okay, our income. We've got this from capital gains, we got this from pensions, we got this from IRA, this from wages. I'm going to ignore Social Security at the moment because that throws another monkey wrench in this. And we add it all up, and we've got that $100,000 of gross income on the tax return. Now, the good thing from there, now we deduct the standard deduction. Mm-hmm. And the standard deduction first comes off of ordinary income. So it reduces all that down. And it's nice. So now we've got that $72,000 of hypothetical income. Let's say 20 of it is from long-term capital gains. To calculate the tax, we pull the capital gain off the top, and we look at $52,000 of taxable income, calculate the tax on that. $22,000 at the 10% bracket, the rest at the 12% bracket. And then we look at the capital gain.
Add that back in.
Did the total income exceed the zero threshold, the top of the zero bracket, which is just shy of the top of the 12% bracket? Nope. Then all of that gain is zero. We don't even have to pay tax on it. It's a wonderful thing.
Well, it is, but I mean, how many people understand that?
Right.
And how it works and how it all works from a planning perspective. I think if you're a client and you say, well, I can take money from here, I can take money from there, the planner should be able to tell you, if you take it from this account, it's going to cost you no taxes. Whereas if you took it over here, it's going to cost you a bunch.
Well, one of the other areas that a planner should be able to help you is when you are doing some rebalancing within your portfolio, you're maybe moving some money from growth to safety, or doing different things. If a lot of times, if you're going to sell something, or buy something, people want to know what the cost is. What is the cost to sell it?
Which means taxes, really.
Well, for most people, that are dealing with an advice, it's the transaction cost. What is that transaction going to cost me? It's a $10 trade, a $5 trade, a $20.
Oh yeah.
It's this whatever. What is it going to cost? Well, it's going to cost you that, but it's also going to trigger a tax or a loss. How much is that? What is this really going to cost me? It's not just the transaction cost. That's the minor issue. The issue is this going to be a taxable event? And unless you know the tax brackets, where you are, what your total income is, you don't know what it's going to cost you. Now, if you know for a fact that you're a married couple filing a joint return, and there's no way in heck that your income is going to go over, $100,000 or $110,000, it's most likely that taxable, that $10,000 capital gain that you just created is going to be a zero tax. But is it a zero cost? Because the tax on that gain was actually zero. But that gain is part of your overall income. And that overall income is used to determine how much of your Social Security is taxable. And that $10,000 gain may have moved $8,500 of your Social Security that was previously not taxable into the taxable column that you pay 12% on. So you're paying 12% on $8,500 on a gain that was tax-free. Figure that one out.
Good luck. And by the way, by the time you notice that you're paying taxes on it, it's too late to do anything about it.
It's after the fact. If you're looking at your tax return and you're saying, my taxes are too high, at that point, you're pretty much nothing you can do about it.
Yeah.
You're past the end of the year that the event happened. But you have to understand, what is the cost of doing what is happening or you're doing? Is it going to cost me in taxes? Is it going to, and the answer isn't you shouldn't do it, because it's just a matter of know what it is, because it still may be the right thing to do, even though it's going to tax. There are times when selling a stock at a high point, it makes more sense and paying some tax on it than selling it at a low point or losing money on it.
Well, I would often think that selling high is better than selling low, but from a tax standpoint.
But from a tax standpoint, I remember back in 2013, 14, we were talking to some clients about selling a security they'd had for 11 months. We're saying, this has been an extraordinary run-up. Maybe we want to take a little off. You never expected this kind of a run-up. Let's take a little money off the top.
So it's been held for less than a year, though.
Right. They held it for 11 months at that point. They're saying, no, we want to wait till, we don't want to have to pay short-term capital gains on it.
Short-term capital gains are, for those that don't know, essentially the same as ordinary income tax. Yeah. But to make it a long-term, you have to have held it for 12 months.
12 months in a day. So
yeah,
they said, let's wait another month. It might have been 5 weeks. And so we can get long-term capital gains on it. Unfortunately, the stock had dropped 22% in that last 5 weeks. So it cost them more to hold it than it would have cost them in taxes. I'm not saying I knew it was going to drop. I didn't know that.
It's a timing issue.
It was just a matter of, wow, you guys have done really well with this. Maybe we should take a little of that juice off the top.
I could see the temptation of waiting, though. What do I do? Do I put my money on red this time? Is it going to?
It's hard. It is so difficult to make those decisions.
But this is why it's important, and this is why we're talking about this today on this episode, because you might think, as I said at the top, well, understanding tax brackets, well, I mean, gee, that sounds a little dry. What do I care? I know enough to look up the tax brackets online and know where I am. I know that if I make $100,000, the thing on the chart on Google says that $100,000 is taxed at 22%. And you'd be right if it were taxable income. It may not be.
It's not all the same. A married retiree couple with $70,000 of income. If you have two couples, they both have $70,000 of gross income. They could have extremely different taxable issues. We say, wait a minute, they're both married. They're the same age. They both have the same amount of income, but it comes from different areas. You have somebody who has a $50,000 pension and a $20,000 Social Security payment, married couple, compared to a couple that has a $50,000 combined Social Security and $20,000 of pension.
Same amount of money, but taxed totally different.
Very different taxability. The one with the $50,000 of Social Security and $20,000 of pension, I can't do the math quick enough, but it's probably going to be close to zero in federal income tax owed. Whereas the other party's going to owe $1,000, $1,500, $1,200, somewhere in there.
They're going to owe something.
They're going to owe
some
money.
More.
Which is like, wait a minute, we got the same amount of income. It's totally different.
If that doesn't show, if that doesn't tell you the importance of having somebody there for you who understands how the tax code works, and I said this a little while ago. I mean, somebody might say, "Look, I might need, $80,000 of income this year," and they go to you and they say, "Well, look, I can take it out of this account. There's an IRA. I've got pensions coming in. Maybe I should take my Social Security instead, or I can take it out of the Roth." I mean, the tax bill is going to depend on, in many cases, which account you take that out of.
I was way off. They would have owed more than almost $5,000 in taxes on that, the $70,000 of income.
If you had $20,000 of social
and $50,000 of pension versus the other one would be zero, and you'd be at almost $4,600, almost $4,700 in taxes.
Yeah, now
that's a big difference.
Well, it is a big difference. Now
we're not saying $400 a month.
Well, and we're not saying your pension is your pension. You can't.
I'll still take a pension, but
you'll still take it. But I'm saying you can't say, well, forget the 50 and 10 pension. I'm only going to take. That's not really how that works. I've got the same
income as my brother-in-law. They're my sister and brother-in-law, but I'm getting taxed at almost $5,000, and they get no tax.
Right. You find out at the barbecue. You know how much your brother-in-law makes. They know how much you make. And you say, well, gee, I only paid $5,000 of income tax on $70,000, and your brother-in-law says,
I paid nothing.
I paid nothing. Beat that fella. It's and again, it's probably because that person understood how taxes work. So anyway, I mean, you don't have to understand everything. I think the important thing here, as I said, is the takeaway should be that you have somebody working with you who does understand how tax brackets work, who does understand the consequences potentially of taking money out of a 401k or converting IRA funds to Roth.
Yeah, you have to know where you are, because again, it goes back, what's it going to cost you to do this?
Yeah, and it's all about knowledge, and that's what we tried to impart here on this particular podcast.
And this is a puzzle that just people don't like to talk. I've mentioned this to people. First off, people don't like math. For the most part, a lot of people just don't like math.
Yeah.
You put a dollar sign in front of it, and people are like, they start getting a little bit emotional. You talk about taxes being part of in math, people just get mad.
People don't like numbers, but when you put dollar signs in front of them, it becomes personal and emotional to them.
Yep.
I mean, it's something tangible, even though money is not tangible.
And when you say the word taxes, people automatically get their dander up. The hair on the back of their neck starts.
Well, you know what? I mean, you complain about taxes, but maybe you're not doing what you need to do to manage that tax bill.
Yep.
And we talk about not necessarily lowering your taxes today or tomorrow, but perhaps lowering them over the long haul, which is what we call managing your taxes. And that's why managing your taxes is more important than paying as little as possible right now in many cases. But it all comes back to knowledge. It all comes back to how well do you understand tax brackets? And if not you, your advisor should understand that, like Professor Plum does. You might want to get in touch with him or any of the Lucia Capital Group advisors, 800-644-1150. Call them at Lucia Capital Group. They can go over your tax situation and say, look, hey, you know what? Start taking money out of this account because it's going to cost you less. I'm just throwing that out.
Or start taking money out of this account to save you in the future.
Yes, and that's the point.
And to save your surviving spouse.
Even better.
We didn't even get into that.
We didn't really get in. Got a little into the Social Security thing. This could have gone 100 different ways, but we couldn't cover it in the time we have. Just understand that you need to understand taxes, and if not, have somebody with you on your side who does. That's the folks at Lucia Capital Group. Again, 800-644-1150. Go online to find more information on this topic and others, videos, blog posts, articles, all that stuff, luciacap.com, luciacap.com. Find our podcast, subscribe to it at Apple, Spotify, and who knows where else. I don't know. It's easy to find. You folks listening found it. Make sure you subscribe, and you can get all this wonderful information every single week downloaded right to your device, and you won't miss a single episode. Boy, this was fun for me. Thank you, Professor Plum. I always feel good when I feel like we've, in some way, if everybody caught what we're saying in this episode, it taught people something they didn't know. Because it just going online and looking at tax brackets, it's a wonderfully proactive thing to do. And you might think that you do understand it just by looking at the brackets, but if you don't know how they work, you're missing the most important part of the story.
And don't forget the deductions, whether it's your standard deduction that everybody gets or itemized if your itemized deductions are more.
Yeah, which is even nicer. My thanks to Professor Rick Plum, CFP professional. For him, I'm your podcast host, Johnny Dean. We appreciate you listening as well. We will, of course, talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material contains tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. No client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Rick Plum is a registered representative with, and security and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.